Have you ever wondered how to start investing? It's a question that crosses many minds, and for good reason. Investing is the cornerstone of financial growth. Think of it as planting a seed that could grow into a mighty tree over time. It's about putting your money to work for you, rather than just letting it sit idle. There are several ways to invest, each with its own level of risk and reward. You've got stocks, where you buy a piece of a company and profit as it grows. Bonds, where you loan your money to a company or government for a fixed return. Mutual funds, which allow you to invest in a diversified portfolio with a single transaction. And then there's real estate, a tangible asset that can provide a steady income stream. Investing is not just for the wealthy. Anyone can start investing. It's about making informed decisions, taking calculated risks, and being patient. It's a journey of financial growth and independence. Why should you start investing from an early age? Well, there's a simple yet powerful concept at the heart of investing: compound interest. Picture this. You plant a seed in a pot, and over time it grows into a small tree. The tree then starts producing seeds of its own, which fall into the pot and start growing into more trees. Before you know it, you have a mini forest in your pot, all from that one single seed. That, in essence, is compound interest. When you invest your money, it's like planting that initial seed. Over time, your investment grows, producing earnings. If you reinvest those earnings, they too can grow and produce even more earnings. This cycle can continue, and the longer it does, the more your wealth can multiply. Starting to invest early has several advantages. First, time is a crucial factor in the magic of compounding. The longer your money is invested, the more time it has to grow and multiply. It's not just about the amount you invest, but the time you give your investment to grow. Second, investing early gives you more time to recover from any potential losses. As with any venture, investing involves risk. You might lose money. However, when you start investing early, you have more time to recover from those losses. You can learn from your mistakes, adjust your strategy, and still come out ahead in the long run. Lastly, investing early can help you develop financial discipline and knowledge. The world of investing can be complex, and it takes time to understand it fully. Starting early gives you the chance to learn, grow, and become a savvy investor. So why should you start investing early? Because every day that passes is a day that your money could have been working for you. It's an opportunity to grow your wealth, learn valuable skills, and secure your financial future. The sooner you start investing, the more time your money has to grow. Ever wondered what makes a good stock? Well, it's not just about the current price or the latest buzz. A good stock is like a sturdy tree. It's rooted in a healthy company, stands tall in its competitive landscape, and it's expected to grow in the future. Let's break it down, shall we? First, we look at the company's financial health. This is the root system of our tree. We want to see strong fundamentals like a robust balance sheet, solid cash flows, and consistent earnings. A company that's financially sound is more likely to weather economic storms and provide a steady return on your investment. Next, we consider the competitive position of the company. This is the trunk of our tree. Is the company a leader in its industry? Does it have a unique product or service that sets it apart? A company with a strong competitive advantage is often a safer bet, as it's less likely to be toppled by rivals. Then we look at the company's future growth prospects. These are the branches reaching for the sky. We're looking for signs of potential expansion, whether it's entering new markets, launching innovative products, or simply growing its customer base. A company with strong growth prospects can provide higher returns as its profits increase. But remember, even the tallest trees can be brought down by a strong enough storm. That's where diversification comes in. By spreading your investments across a variety of stocks, you can reduce the risk of any single stock's performance significantly impacting your entire portfolio. Think of it as planting a forest instead of just a single tree. So what makes a good stock? It's a combination of a company's financial health, its competitive position, and its future growth prospects. But don't forget the importance of diversification. A well-diversified portfolio can offer a smoother, more stable journey to your financial goals. Investing in a good stock is about more than just its current price. In the end, it's about understanding the company behind the stock and making a well-informed decision. How do you know if a stock is a good investment? This is the question that keeps many potential investors awake at night. Today, we will explore different ways to evaluate a stock. Firstly, one method is studying the company's earnings reports. These reports reveal the company's earnings or profits, and they are typically released quarterly and annually. When you're looking at these reports, you're looking for a trend. Is the company's earnings steadily increasing? If yes, that's a good sign. If earnings are fluctuating wildly or decreasing, that could be a cause for concern. Secondly, you will want to check the stock's price-to-earnings ratio, often referred to as the PE ratio. This is a valuation ratio of a company's current share price compared to its per-share earnings. A high PE ratio could mean that a stock's price is high relative to earnings and possibly overvalued. Conversely, a low PE might indicate that the current stock price is low in relation to earnings. However, this ratio should not be used in isolation, as it doesn't tell the whole story about a company's financial health. Another vital aspect in evaluating a stock is understanding the company's business model. What does the company do? How does it make money? Is its business model sustainable? Understanding this can help you determine if the company has a long-term future, and whether its stock is a good long-term investment. Also, consider the company's competitive position. If the company has a unique product or service, or if it's a leader in its market, it could be a good investment. However, if the market is crowded and the company doesn't have a unique selling proposition, it may struggle to stand out and succeed. Lastly, don't forget to assess the company's management. Are they experienced? Do they have a track record of success? If the answer is yes, that's another point in favor of the stock. Knowledge is power when it comes to investing. The more you know about a stock, the better your investment decision will be. Remember, investing isn't about making quick wins, it's about making informed decisions for long-term growth. Ready to start investing? There are plenty of apps that can help. In the digital age, it's never been easier to take control of your financial future right from your smartphone. Let's dive into some of the best investing apps for beginners that can help you kickstart your journey. First up, we've got Robinhood. This app is known for its user-friendly interface and zero commission fees. Robinhood allows you to buy and sell stocks, ETFs, options, and even cryptocurrencies. It's a great platform if you're just dipping your toes into the world of investing. Next, there's Stash. Stash is an app that makes investing feel less intimidating. With as little as $5, you can start buying fractional shares of stocks and ETFs. Plus, Stash offers educational resources to help you learn as you go. If you're interested in automated investing, Betterment could be the app for you. Betterment uses robo-advisors to automatically manage your investments based on your goals and risk tolerance. It's a hands-off approach that lets you invest without needing to constantly monitor the market. For those who want a deeper understanding of investing, E-Trade also has a variety of investment options, making it a great choice for beginners who want to expand their knowledge and experience. Finally, there's Acorns. Acorns rounds up your everyday purchases to the nearest dollar and invests the difference. It's a great way to invest without thinking about it too much. Plus, Acorns also offers retirement and checking accounts, so you can manage all your finances in one place. Remember, the key to successful investing is not just picking the right app, but also educating yourself, setting clear goals, and staying disciplined with your investment strategy. Each of these apps offer unique features and benefits, so take the time to find the one that best suits your needs and investment style. With the right app, investing can be as easy as a few taps on your phone. Investing may seem complex, but it doesn't have to be. As we've seen in this video, investing is all about understanding the different types of investments, knowing the value of starting early, and being able to recognize a good stock when you see one. We've also highlighted the importance of evaluating a stock and using the right tools, like the best investing apps we've talked about. Remember, the key to investing isn't about quick wins. It's about making informed decisions and sticking to your plan over the long haul. And while the world of investing might seem daunting at first, you're now equipped with the basics to navigate it. So here's a challenge. Take what you've learned today and make your first investment, because once you start, you'll open up a world of possibilities for financial growth and security. Remember, the best time to start investing was yesterday. The second best time is now.